Welcome to the July 14th meeting of the Oklahoma City Post-Employment Benefits Trust. And the first item that we have this morning is the approval of the minutes. Can we get a motion?
Second.
All in favor?
Aye.
Any opposed? All right. Next item we have is some electronic document training from Mickey. Mickey Graham is with the City Clerk's office, and she was going to walk us through how to access documents and review documents electronically. So, Mickey, I'll let you take it from there.
Okay. So with the new electronic agenda management system, your meeting is new to it. The system itself is not new. We now have the ability to electronically manage the agenda and all of your supporting materials, and then publish those materials at opebt.gov, which then gives the citizens as well as the board members electronic access to those documents. So it would allow you to either eliminate your packet if you no longer want to receive the paper packet because you would have access to the information online, therefore reducing our paper output as well. But to get to the agenda and the materials online, go to opebt.gov. And on the left-hand side of the page, if you go down to the meetings link,
Hey, Mickey, could you? Maybe you probably know how to turn it on.
Okay, so from okc.gov, select meetings from the left-hand side of the page, and then you want to scroll down to the Oklahoma, let's see here, where is your trust? The Post-Employment Benefits Trust, and when you click there, it will take you into the SIRE interface, which is our electronic system, and you again have to scroll down to your meeting, and all of your meetings from the time that we started it in the system will stay in here, so you can go back and search prior meetings for documents if you need them at a later time, as well as once the agenda is published for the next meeting, those documents become available. So here is today's meeting, and as you can see, you have access to the agenda. If you click on the agenda, it then takes you in, and after the meeting, once the video has been edited and published, the video also becomes available with the agenda. And so when you scroll down, you see all of the items. They are hyperlinked. So if you click an item, it will give you the supporting materials, as well as it will jump to that section in the video once the video becomes available. And if you click on the PDF icon of the document, it will bring the document up. And so this works for any reports or any items that are on the agenda. You can attach all of those documents for viewing. You can also, on your from your agenda here, if you click on View, it gives you access to a PDF copy of the agenda, as well as, again, all of the supporting materials are listed here. There's also the packet. If you click on that, that gives you the same packet that is distributed to you prior to your meeting, so you can scroll through and see everything here. And after the meeting, once the minutes become available, then those are also posted on here, and you would get a link to those. So I can go to a prior meeting so that you can see what that looks like. So for searching, you just select your meeting type out of the drop-down box. And you can put in a date if you want to limit the date range. Click Search. And then so here's your list of all the meetings since you started in the electronic system. So it goes back to June of 2013. The agendas and the minutes. And then the video as it becomes available. So here's one with the minutes. You can click the minutes. Scroll down, and here are the minutes. And those are typically linked as well to the supporting documents.
All right, the next item is to receive the monthly investment flash report for March 31st and the report for April 30th.
Does anybody have any questions?
Any questions? All right, thank you, Mickey.
You're welcome.
Appreciate that. That'll just save us from having to save these piles and piles of paper. And if you get to a point, because you can pull it up like on an iPad, or if you have a laptop or whatever, you could just bring it to the meeting and use that if you didn't want to have the paper copies as well. All right, thank you.
One issue, Mr. Chairman, that's a neat system, and I certainly will use it. I hope, though, that, let me back up. Oftentimes, I do not look in retirement at my calendar. So I use the notices that I get from Diana as a reminder, A, that we have a meeting scheduled, and B, that it has not been canceled for some reason, because sometimes I do and sometimes I don't get emails. So I would still like to have at least a pre-meeting reminder that this is available at where, particularly for the first few months.
And the reminder that you're talking about is the email reminder that goes out?
The email reminder,
yeah,
yes.
Yes, and I think our intent is to continue that.
Okay,
We don't have any intent of changing that. This is just a way that you had this access to these, and especially from my perspective, I was just stacking up piles and piles of these agendas, and now we have them all. We'll have them all online, and we can just go access the information. Don't have to save that.
I have all the used paper one-sided that I for the rest of my lifetime. So no, with that caveat, so long as we still get some sort of email reminder prior to the meeting.
Yeah, I think all of that will be the same as it has been.
Excellent. Thank you.
Thank you, Mickey. The next item is the monthly investment flash report for June 30 through June 30, 2014.
Good morning, Mr. Chairman and trustees. Can everyone hear me? Yes. I didn't know that I was being recorded on video this entire time, so let's see. Not much to spruce up here, but
there'll be no upcharge for hair and makeup.
I don't have that much time. No, that's extremely interesting. I saw when she was scrolling through the meeting dates that she pulled up the meeting that we had with the investment committee on June 26th. That was one of the things that she noted, and we were very busy on that day, and I think we're going to be talking about that in a few moments. But before we go to there, I think we need to cover our mid-year market performance, or our flash report. You'll see on the first page there in the bright colors where the market returns were for the month in the last year, and the monthly returns were quite good on the equity market, not so great on fixed income, but when we're looking back over the last year, you can see how fortunate we've been. We have a blended portfolio of equity and fixed income, and the returns from the equity market have been extraordinarily generous. And as we turn the page to the following preliminary update, you can see for the last 1 year, the total fund was up 15.2%. It did trail the policy benchmark. Some of that came from fixed income managers. Some of it came from our equity managers who, as we remember, are slightly more cautious than the overall market. They're managing the portfolios with volatility in mind and capital appreciation. But you see that the poorest return we have out of all of our managers on the equity side was 18.3%. I'd call that a pretty good year going back. If we go back over the last 3 years, 8.4%, again, some of the same issues. The markets have been running so fast. It's very difficult to keep track or keep up to pace with equity portfolios. But as we remember when we go into down markets, that these active managers do help moderate some of that volatility. For the last month, you see we had a nice return out of Stevens, 7.5%, following up a difficult month last month. And you'll notice that our managers tend to skip around as far as which one is our best performer month to month or quarter to quarter, and that is by design. But you'll see that our Dreyfus appreciation, our very large cap portfolio, was up 6.5% over the last 3 months, and that offsets some of the difficulty in the Stevens portfolio. And you'll also see that Causeway is having some issues as well, but they are poised to perform in the future if you look at their long-term record. Biggest number I'd like to call attention to on this page is the total fund, total market value, $29.9 million, which is an astonishing rise, both from returns and also from very strong cash flows as well. Happy to take any questions about the preliminary report.
Are there any questions? Thank you, Doug.
Thank you.
I guess you can stay right there, because the next item that we have is to approve recommendations from the investment committee, and we had an investment committee meeting last month, and Doug is going to give us kind of an overview of some of the changes that we're looking at for the portfolio or for the policy.
Thank you, Mr. Chairman. This is broken up into two pieces. We submitted a draft review of the investment policy statement, updating it. Some of the suggestions came from our offices, some came from Bob's office, Bob Ponkilla's office, and you can see the majority of them in the first piece here. During the meeting, we decided to add a second part, and that is in the following page. But as we go down this list, you can see that some of these are somewhat routine. The first item in the bullet points there is to change the percent of assets invested in the security of one issuer on cost. We gave the manager some additional ability to concentrate in some names. 7.5% is still extremely prudent in our opinion. As we go to the next one, we added a section for high-yield fixed income, which is a new part of the fixed income portfolio design that we've recently completed. Minimum asset allocation for core fixed income went from 30 to 24% because we're moving some of that into high-yield fixed income. We made an update on the amount of time. We changed the 3 to 5 year period, which was to indicate a full market cycle. We removed the time period there to indicate that we were judging over a full market cycle, regardless of how long that might be. 3 to 5 years we don't think is definitive enough there.
Doug, I missed the investment committee meeting, and I apologize for that, but can you describe to me how a full investment cycle is measured?
Generally, it's defined on the equity market, and it's generally defined as from peak market level to trough market level, and vice versa. So we are in a market cycle right now that started March 9th of 2000. Is it 9 or 10? I can't remember the big numbers. But as you'll remember, that we had a very difficult 2-year market cycle before that. Again, now that's one thing. I think that I would define it over the entire rise, then fall, or vice versa. So it is an indication of the health of the market, giving the managers an opportunity to show their skill in up market and down market. Shall I move on? Mm-hmm. Yes, thank you. And you will see that there's an additional disclosure. Any personal financial positions held by employees or investment officials and consultants must be disclosed within 30 days. Prior, it was 90 days, and then there were some other minor administrative changes throughout the policy. This is the upkeep part of the investment policy process. During the meeting, we discussed also that we would like to have this type of meeting at least once per year going forward, so we can address investment policy issues and other emerging issues from the portfolio.
All right, are there any questions? I would take a motion then to approve the amendments to the investment policy.
So moved.
All in favor?
Aye.
Any opposed? All right, thank you very much. Next item is the recommendation from the Investment Committee to authorize the investment manager to include an active duration manager in the investment portfolio. Doug?
Thank you, Mr. Chairman. You can see on the following page that there's another explanation of investment policy change. During the Investment Committee meeting, we submitted a redesign of the fixed income portfolio that we think was definitely due. We were still with the original fixed income manager, just one of them with the portfolio, and that portfolio looked to be fit for improvement, I think is the nice way to say that. So in our process, we went back to our offices and we designed a variety of more all-weather fixed income portfolios that combined more than one manager, including core managers, high-yield managers, and this thing called an active duration manager that is supposed to be a hedge to equity market volatility. You can see the explanation on the page that covers this within your agenda, and you will see that there is a new section that we would recommend be added to investment policy statement to govern this specific type of portfolio, and it is shown in full, section 3B.6.
Doug, could you explain what an active duration manager is?
Sure. In the entire lexicon of fixed income management, you have most managers which are core and they invest the portfolio in a variety of treasuries, mortgage backs, and corporate bonds. They keep the duration or the dollar-weighted maturity of the portfolio very close to the benchmark. All that says is that when interest rates move, their portfolios will behave in much the same manner because interest rates are the biggest determinant of fixed income portfolio returns. What this manager does is something completely different. They don't invest in corporates, they don't invest in mortgages, they build a portfolio around one thing, and that is their expectation on the future of interest rates. And that makes them very different from the other managers in the sense that they will vary the duration of the portfolio quite markedly from the market or from the benchmark. So the Barclays Aggregate Bond Index has a duration of roughly 4 right now, meaning that any 1% rise or fall in interest rates will, you translate that using duration, indicate a price movement or a return movement of 4% for every 1% rise. This manager takes the interest rate risk into their management process and will position the portfolio to benefit from what they think interest rates are going to do. They will go from as short of a duration as virtually 0, meaning that they are hedged against interest rate changes, or they will go all the way out to 20 duration, meaning that they expect interest rates to fall or stay roughly where they are. This is an extremely valuable tool in a portfolio because it perfectly offsets equity market volatility when it rises. So when the equities start going down, this portfolio not only will pay interest, but it will also perform in a manner that will offset temporary losses in the equity portfolio. We think that this is an extremely useful piece to have in your portfolio. We use it in many of our clients in much the same way. And while it may seem very risky in the short term, the bonds are all treasuries. There's no credit risk in it. And the firm that we are suggesting do this does nothing other than manage these portfolios. It's a very extensive answer, but I'm happy to take more questions.
Down the road, if there was a decision to change the designated manager, would we have to amend this policy statement?
Well, this is a very narrow policy as far as governing this type of manager. If you decided not to have that manager anymore, this could be left in. It doesn't require a policy change to add or take the manager away. I think that one way to look at it, if you do have an active duration manager, it will be covered by this. If you don't, it doesn't really matter that it's in there.
And it allows for an active duration manager. It doesn't prescribe which one will select.
Mm-hmm. You said that much better than I did. Thank you.
All right. Are there any other questions? So that I'd accept a recommendation that we move forward with the second amendment to the policy to allow for the active duration management. Can I get a motion? Second. All in favor?
Aye.
Any opposed? All right. Sorry, the next item that we have is to receive the presentation on the fixed income review.
Thank you, Mr. Chairman. This was one of the more interesting parts of the meeting in the sense that this is a redesign of a major part of the portfolio. You'll see in your packet it's stapled together, labeled Fixed Income Review, July 2014. And again, this was motivated by timing. The fixed income portfolio's returns have not been up to par, and we thought that just as we did with the equity portfolio 2 years ago, it would be a good time to take a complete review of fixed income, and now that the assets are higher, perhaps put a more sophisticated structure in place. I mean to do a high-level review of this today. We have a recommendation. I'm here to answer any questions that you have. There were additional data requests that came out of the meeting that are inside of this review. But again, tell me how much, if I'm taking too much time with this, just one of these and
okay.
I can shut it down. The page 2, you can see the background of the project. Again, I've already said what that is. Page 3 shows the managers that we are considering today, as well as Portfolio 2A. We built and tested a variety of portfolios of different allocations. Portfolio 2A is the one that we ultimately recommended, and it does include the 4 managers above. It does not include the current manager at J.P. Morgan. You'll see that we have DoubleLine, which is a core plus fixed income manager. It's a relatively new firm, but their results have been quite good. You can see over the past 3 years, 4th percentile rank. Loomis Sayles is a very old firm, a very qualified firm, a very deep firm that is extremely innovative even today. You can see their results. Loomis Sayles High Yield is a high-yield specialty portfolio, meaning it invests in below investment-grade bonds. And Loomis Sayles, again, same firm, but we think that their talents are peerless in the industry when it comes to buying high-yield fixed income bonds and building them into a portfolio. And Hoisington is the active duration manager that we are recommending to be a part of this puzzle. You'll see what we put together with the Portfolio 2A results. You can't really rank those because this is a composite of 4 underlying portfolios, and we compare that to the indices, and we compare it to the current portfolio. All of this is as of May 31st, but if we look at the last 1 year, this portfolio would have returned 5.86 versus 2.13. For the current manager, over the last 3 years, 7.53 versus 3.62. And over the last 5 years, 11.94 versus 5.3. So you can see that the returns looking back are quite good. Looking forward, we think that the managers, as combined, have as good of a chance of outperforming the current manager as they have in the past. We have a great deal of respect for all 3 of these firms, all 4 of these teams, and their ability to adapt the portfolios to whatever interest rate environment or market environment that we are in. So as we go on following pages, the review of DoubleLine appears on page 5, founded in 2009. As we look on the following pages, Loomis Sayles is covered on 1 page. Wasatch Hoisington is the way that we can access this. And I wanted to cover on page 8 the upside-downside capture ratios, which is new information that was requested. You'll see that on page 8, DoubleLine captures 130% of the upside of the market, while only 77% of the downside. What that tells you in month-long periods, calendar months where the bond market has posted a positive return, DoubleLine enjoys 130% of that return. In months when the market is down, DoubleLine suffers only 77% of the loss. So you're getting more of the upside, less of the downside. With that portfolio, Loomis Sayles, a similar, slightly better, actually, profile where they're enjoying 140% of the gain but only 40% of the loss. And bear in mind that DoubleLine and Loomis Sayles were put together quite consciously because they invest in different parts of the market. DoubleLine has historically been very active in the mortgage-backed security market and the asset-backed security market, while Loomis Sayles has been in more traditional corporate bonds as part of their added value. So we like that because we have 2 different sources of added value from our core managers. Aberdeen should have been struck from this page, but again, you can see that their upside-downside is attractive. And then you have Loomis Sayles High Yield. When the bond market is up, they're up 154% of that. When the bond market is down, they're actually up 30% of that. So it's an excellent upside-downside profile. Hoisington are in their own world, and the fact that the bond market moves in one direction, you can see that they're very amplified. They've been long duration for a very long period of time. They have the ability to move the portfolio to cash and then move it back out to 30 years if they see that the best way to profit in the markets. And you can see our current manager with a very restrained portfolio upside-downside capture ratio.
Doug, the Hoisington number, the
Yes.
downside capture, looks huge. Is that Is that right?
It is correct. It's an extremely unusual portfolio. If you look at the beta on this portfolio, remember, most bond managers, most bond indexes have a very narrow channel of returns, whereas Hoisington has much more volatility. It's just that volatility is very good for the portfolio in the total sense. If the equity market is down 20%, as we have seen in the past, this portfolio will be up 20%. We've seen it time and time again, and it's a very simple portfolio, but it's deceptively effective in reducing total fund volatility. The numbers look odd. We've had this conversation with clients many times in the past, but when the markets get difficult, it truly is the best hedge that we have seen. So far this year, if you look at the upside-downside capture ratio, if you look at actual returns, Hoisington's up about 15% this year, whereas most bond managers have struggled. Last year, they had a difficult year because interest rates rose prematurely in their eyes, and they have almost made up all of last year's losses very quickly. It's an all Treasury bond portfolio. It's all based on their expectation of interest rates, and they are very long-term thinkers. So, the following page, we think that it is incumbent upon us to look at the following page because it is fees. These are the expenses. All of the returns we show are net of expenses. The previous manager was 58 basis points. You can see that the managers that we are showing here are somewhat close to that. Double Line as less than that. Loomis Sales is slightly above. Aberdeen, again, that was one manager that we decided to strike during the process. Loomis Sales, high yield, it's a more expensive asset class than Hoisington with their very interesting process as a higher fee as well. But all of these are prudent, all of these are reasonable. Happy to take any more questions, Mr. Chairman, trustees.
Pardon me, this question. The recommendation then is to split our core, our fixed income equally among the four.
That's actually,
So if we go to, it's Appendix 2, right?
or if you go to page 3, it also shows it as well.
Yeah.
You'll see underneath it says Portfolio 2A in boldface below the gray shaded area. 40% Double Line, 40% Loomis Sales, core, 10% high income Loomis Sales, and 10% Hoisington. Hoisington is very, we want to use them in a very prudent way because of their volatility.
So the recommendation we'll be looking at is Portfolio 2A.
Correct.
Okay. So the next, are there any other questions?
No, thank you.
Okay. And so the next item that we have then is item 8, which would allow us to actually take action on this. So we could take a motion on recommendation of Portfolio 2A if that is the pleasure of the board. All in favor? Aye. Any opposed? All right. Thank you, Doug.
Thank you, Mr. Chairman and trustees.
And that means we're completely dropping the J.P. Morgan. We're substituting this completely for the J.P. Morgan.
Correct.
Okay, thank you.
All right. The next item that we have is item 9, an election of a vice chair. Currently, Laura has been serving as our vice chair, and basically we just have someone in place that if in the event that I wasn't here, I didn't show up on time, someone could start the meeting. And she's willing to continue to do that, but if someone else would like to volunteer, she's willing to allow them to do so. So I would take a motion either to recommend Laura or anyone else who would like to volunteer.
I nominate Laura.
Oh, I thought you were going to volunteer. All right. So all in favor as Laura continuing to serve as the vice chair? Aye. All
Can I
right.
get you a food taster?
Yes. That was it. All right. Next item is acceptance of the interim financial statements. Were you going to present anything on that this morning? Yes. Great. It's Mitchell Massey from our Accounting Services Division.
Good morning. I would first like to direct your attention to page 3, the management discussion and analysis changes in net position reconciliation. Currently, the trust is reporting net position at $33.1 million. This is an increase of $7.9 million over the prior year when the net position was $25.2 million. Overall, the financial position has improved. For the fiscal year, the trust has gained approximately $6.79 million. Of this, $3.17 million was generated from investment income, while the remaining $4.3 million is from excess employer contributions, offset by a loss of net assessed revenue. Next, I would like to direct your attention to page 6, the statement of changes in planned net position reconciliation. Additions are reporting at $29.6 million versus a $28.6 million in the prior year. This is mostly due to investment income increases for appreciation and fair value of investments, as contributions remain stable. The benefits were $22.8 million, which was an increase of $190,000 as a result of the indemnity plan expenses increasing at a higher rate than the contributions. Now I would like to direct your attention to page 10, the asset allocation guidelines. In our asset allocation guidelines, the fixed income securities were reporting at 30.1%, leaving the remaining to equities at 69.9%, which is right on target. If you look above on page 9, the money markets used to pay claims are reporting at $4.1 million compared to the prior year of $3.2 million. Are there any questions I can answer regarding the financial statements?
Are there any questions? All right, thank you, Mitchell. So we actually have to vote that, don't we, to accept the... So I take a motion to accept the interim financial statements?
So moved.
Second.
All in favor? Any opposed? All right, thank you. Next item is to ratify the claims listing. All in favor? Any opposed? Are there any further reports from staff or board members? All right, with that, we are adjourned. Thank you all.